Generational wealth. What does that mean to you? Well, there's a couple of ways you can look into this. In fact, I'd be interested in what it does mean to you in the comments. So if I said generational wealth to you, what's the first thing that comes to mind? Drop it in the comments and we'll have a chat about it. Now, to me, I think there are two ways you can look at it. There's the typical meaning as you would find in an Oxford Dictionary, but you can also look at it this way. It can be one generation giving wealth to the next generation, or it can be a fund of money that generates its own wealth. Now, I'd like to think the way that I'm setting my Vanguard up, it does both. Now, I wish I knew when I was younger what I know now. I'd be far way ahead of where I am. But hindsight's a wonderful thing. But something triggered on me this week and I was thinking about this. Now, I'm a big advocate in little and often and one thing another. And you see that in my Vanguard. And we're going to go to it at the end of the video, so stay around, where I'll show you where it is and how much it's worth. Now, if anybody here is following me on my other channel, which is the Scruffy Trader, you'll actually see what I do for a living. Market analyst. I speculate on currency movements and indices, and I make a wage from it. Surplus money goes into the various sort of investment funds that I have. In this case, the Vanguard. I have some for Joanne as well. And I also have them for my kids. Now, what that means is I can take a wage and whatever's left over, I can put to one side. Now, you can also do that with surplus money. And what do I mean by surplus money? What if you just didn't have a coffee today? I mean, I go Starbucks, I get no change out of £5 for a coffee. So I can easily spend somewhere between 20 and 40 quid a week on nothing. You know, a pie in Greg's, a odd McDonald's, a couple of coffees while I'm having a meeting with somebody. And it's not too difficult or a stretch to spend sort of, I don't know, even let's just say 35 quid a week. You know, it's not a stretch to spend that. Well, what if you cut it back and you could save 30 quid a week or 40 quid a week? Or if you sort of follow what I do on the other channel, make 30 or 40 quid in some kind of side movement, whether it's selling a couple of things on eBay or whatever, right? And I'll kind of tell you where this comes from. On the other channel, I was doing a breakdown of something, and it wasn't really willing to give a lot of money. It was only about 30, 40 quid. And then I got this comment here, you know, 36 quid here and there, not really worth the aggro, is it? And I'm thinking, well, yeah, it is, because it all adds up. Certainly if you're doing it a couple of times a week or a couple of times a day, it don't half add up. So I thought, I wonder what Joe Public would think of this. So I put it out to a poll to see whether it's worth it. Well, 36 quid a day, is it worth it? Well, if you do it 3 times a week, over 48 weeks, that's 5,184 quid without anything. Now, bear in mind, that's a poll based at people that are actually trading and they're speculating and making money per day rather than saving money. But 6% said it was a waste of time. Now, if somebody was in the street and they were handing out £20 notes, would you take it? Pretty sure you would. But 6% of you say it's a waste of time. Interesting. So then I put it out. This is to sort of public. All right. Then I put it out to people that actually are within sort of a WhatsApp group that I moderate and post up. Tell them what I'm doing. And I put it to them. Now, these guys, they're all in it to sort of make some speculations, investments, whatever. Is it worth it? 100% of them said it was worth it. 100%. Now that, to me, sort of spoke volumes about the way Joe Public is. I don't think Joe Public think past tomorrow. So when you say generational wealth to them, it wouldn't mean anything. But they expect it to be given to them straight away. You know, I remember having some of the conversations with my kids when they're sort of in their teens and getting into their 20s, expecting the world to be just handed to them. And then the cold, hard reality is, no, you got to work for it. And it's like, what? Yeah, you fucking work for it if you want it. But I then started thinking recently about my grandkids. And I was thinking to myself, I should really set something up for them. And that's what my Vanguard is. That's where it's going to go. So really, I've actually turned, it's the old thing, the parents are ogres, but when they become grandparents, they're just cuddly little toys. Well, that's what it's like in our house, because the grandkids get what they want. Now, I'll get them to the point where they mightn't actually have to worry. And this is how it's getting done. So think about this way. Let me just pull up something. And this is a relatively easy way to do something. So we're going to look at a compound calculator. But I'm also going to look about what investing is on safe investments. Whoa, well, when we're talking about investments, he's the fucking worst one. What you mean? What do I mean? Let's put it this way, right? Investing in you is a bad investment.
What?
Well, if I give you 100 quid, I'm not getting 110 back, am I?
No.
No.
You'd be lucky to get anything back.
Be lucky to get anything back. I rest my case, Your Honour. Bloody hell. Right, let's have a little look. So the S&P has been around quite a while. Average return of S&P 500 over 50 years. All right, should be about 10%, give or take. 10.5, all right, over the last 55. Now, bear in mind, you will have to take into account inflation and one thing and another. And, well, there you are, after inflation, it's about 8%. All right, okay. So an 8% return over that period of time isn't bad. But what we're going to do is we'll put into the calculator just 8% to get a leg up. Right, let me have a quick look at this. So what I'm getting at is, if you started with a principal amount, I'll take that 36 quid, 36 pounds. And that's what you're going to put in. And yeah, we'll leave it at 8% per year. And you're going to do it, I don't know, sort of every week for 21 years. All right? Why 21 years? So on your kid's 21st birthday, you're giving that kid 36 quid pocket money every week for 21 years. All right? So additional profits, 36 quid. Calculate. Right. On its 21st birthday, that fund would be worth approximately 102,672. So we're going to say it's approximately worth 100,000, 100k. And that's because you've just put that pocket money religiously into a Vanguard every single week for 21 years. Now, most people will never commit to that, but in reality, it is doable. Now, what you do is you go, well, it's a one-off fee of 100,000. Okay, so that's 100,000. You're not going to put anything into that ever again. And you're just going to leave it there accruing an average of 8%. Now, when would somebody like to retire? 55? 55 is a good time to retire. Okay, so why not? So what's that? That's 21, that's 42. 29, 30 years. Let's just say 30 years. So he'd be 51, you know. So for 30 years, no further investment, that child's fund would now be worth 1.1 million. Now, what you've done there, and it's a very simple, and it is a play on numbers, I do appreciate that, is most parents will invest for their kids. Now, if you put a very small amount away every week of that child's life from the day they're born till the day they're 21, when they become officially their own independent adult, and then stopped, that child would be set for their future. That is the best gift any parent can give a child. Setting them up knowing that their future life will go on very comfortably when you're not here. That, to me, is what generational wealth is. And it comes from something as simple as 36 quid, which was said, is it worth the aggro? Well, you tell me. Do you think it's worth the aggro? I certainly think it's worth the aggro. In fact, I'll stand by that every single day, because there isn't a parent alive would not go through that knowing what the outcome is. In fact, if it's a case of you have to press a button, but every time you press that button to get that 36 quid, you cut your fingers every time you did it. But you knew that what you were doing was setting up that child. Not one parent would never push that button with a razor blade on it. I would cut my fingers off if I knew the outcome. But it's not worth it. It's not worth the aggro. Something for you to think about. Let's have a quick look, see what my Vanguard is, what it's up to. I have just recently updated the sheet for those that are following, and then we'll look at directly on the fund itself so you can see it in real time. I did get a comment off someone who's saying that it's photoshopped. I'm not rightly sure where they got that idea from, but we'll log it on and I'll show you that it's not photoshopped. So here we go. The fund is currently sitting at 225,998.75. I've smashed the targets on two of the funds. The standard is just chipping along. It doesn't have far to go to hit its target. And the extra fund, which we will see, and I'll just flick it over so you can see it all, is catching up. So we smashed the target here, smashed the target there. This doesn't have far to go, that does. We've got a decent amount into it this month. In fact, we've got quite a bit into it this month, which has boosted it up. And that means the change in 1 week is just shy of 10%. Now, that's 1 week. Bear in mind, it is taking into account the amount of money I put in personally. But it's making money. But it's only making money by what I've put in. The actual interest is gone backwards. But the fund, from starting on the 1st of April this year, which was 177.99, 1st of April, bear in mind we're now on 6th of June, is now sitting at 225,000. So that is substantial. You know, that's like nigh on 50,000 quid. And in fact, it is more than 50,000 quid. So I am quite happy with that at this moment in time, in such a short period of time. But let's have a look at it on the big picture. Bear with me while I log in. Okay, so we logged in. As you can see, 225 just marries over onto roughly what's on the spreadsheet. Currently contributed into this £72,500 in the last rolling year. And those investments have returned 37,227, which is actually down on where it was. So it has come down. However, the graph is moving up. Oh, look, you can see the numbers bouncing. Not exactly photoshopped, is it? Strange that. But we can see what's going on. Now, it's not always a bed of roses. Now, if I take this back, say, another year, just so you can kind of see where we at. So that'll be like June 25, won't it? Well, that'll do. Take it back to May 25 and view it from there. What you'll see is there's a massive change, but this is steady away, all right? There's not a great deal of difference. Now, if you go to year to date, oh, hold on, that's why. So it'll be June. Oh, I'll do that again, actually. Okay, so we logged in. As you can see, over the course of the last rolling year, we've put into this just shy of £72,500 ourselves. That's Joanne and I. And it's returned 37k. But that's down on where it was returning. So you've got to take in the peaks and troughs. And this is why you can't sort of switch your funds about too much. I rebalance it maybe once a year or so, maybe every 6 months. But that's about it. But other than that, I just let it get on with it. And that's what I was driving at with putting money away for your little kid. And I will show you something in just a second. Now, if you look at that, its equity curve is pretty stable. And it has been for the rolling year. But let's take this back slightly. We'll go back June 24. So kind of go back there. So this is like a couple of years worth of data. Now what you can see is the fund a couple of years ago was just shy of 80,000. But the return at that time, because the markets were doing very well, was boosted up, okay? In the short term, they're dying down a little bit, but the longer term growth is far better and contributed in, well, we've contributed over the last couple of years, well, over £100,000. So you've got to keep feeding it. Now, that to a lot of people could be sort of, oh, I can't keep up with that. But you don't have to, because it does start relatively small. And it doesn't take long to build up, because there it is there. You know, even if you're looking at this, sort of the 100,000 and the 79 at that point, it's still growing considerable over the period of time to get to the 225 where it is now. Now, if you look at the months, and this is a bit that interests a lot of people, it's not always a bed of roses. I mean, we're off to a bit of a bad start in June. We're actually down 3,300 at this moment in time. I'm not worried about it. It will come back, because we lost money here. We lost money there. Lost money down here. In fact, we lost a lot of money down here for 3 months. But stayed the course. But the greens are far outweighing the reds, because I use global alt caps. And what that means is it does smooth out the noise. Now, the other side of it is, well, what about your transactions? You'd be putting big, massive lumps in. I don't. You know, 13 quid, 6. All right, put a bit of money in here this week. I did say I was going to do it. And there it is there. You know, 740. It's not a vast amount. 6 quid, 6 quid, 39, 162, 187, 113, 20 quid. These are not huge amounts of money, but they're regular if you look at the dates. You know, just dump it in all the time. And what happens is it builds up massively. And that's why you end up with this. Because like I say, it's not great deals. It just dumps little bits of money in. So I'm quite happy with this. And the last check that I did, which was 30th of May, that week at that point had grown by 1.7% and had made 3,456. Now this week, yes, we've put money into it, which has boosted it up, but it actually lost 3 grand. But are we worried? No, we're not. So what we'll do now is we'll reset it for the next time I check this, which will be there. So there's no way it'll equal this next week. But what it shows is that as long as these constantly become positive, I'll be happy. And the balance last week was 2005, and now we're at 225. So there you go. Right, so 225, 99875. That resets. That's what we did on the last check, and we're now going to see what we'll do on Friday coming. Now Friday coming might be a little bit bitty, because in fact it won't be Friday coming, because what are we doing on Friday coming?
We'll be on holiday.
We'll be on an aeroplane. We will be sunning ourselves. If you go through this particular channel, you'll see there's a hotel that we go to called the Lamar in Tenerife. I might do another little walk round of it, because it's one of our places that when we've been before, we're going to go back to it. It was that good. Are you looking forward to it?
I am actually, yeah.
Oh, yeah. I'll try not to break my toe this time.
Well, which way are you walking?
I did. Yeah, if you watch the video, you'll see a bit of it where Scruffy has a bit of a drink and falls in a tree. I broke my toe. But never mind. So there you go, kids. Little and often, generational wealth does work, but only if you're committed to it. You cannot mess about and go, well, I'll skip it this week or I'll skip it this month. Constantly drip feed in. You're better off, instead of skipping, put less in. So if you can only put 30 quid in, and then 1 week you can only put a fiver in, still put the fiver in. And over the time, it'll mount up, and then it'll get to a point where it doesn't have to be fed anymore. I'm getting mine to a point where it doesn't need to be fed anymore. It'll keep on going. The interest will help me with our retirement. So that'll give us some treats and whatever each sort of month and year. And then when we finally shuffle off this mortal coil, the lump of money that's left, which I'm going to instruct the kids to leave it where it is, and then every year they can live off the interest from it. That's generational wealth, and it's what I want. And the bigger I can get that fund, the easier it'll be for those kids. Cherish your thoughts. Catch us all in the next one.